Most people who have an opinion on AST SpaceMobile are comparing it to the wrong company. They hear satellite broadband and they think Starlink. They picture a dish on a roof, a separate subscription, a different network. And from that frame, ASTS looks like a smaller, slower, underfunded version of something SpaceX already built. That framing is wrong, and it's the reason a lot of people are reading this thesis incorrectly. ASTS is not trying to compete with Starlink for customers. It is not selling you a plan. It is not asking you to buy new hardware or change your carrier. The entire premise of the company is that your existing phone, the one in your pocket right now, on whatever carrier you already pay, works from space. No new device, no new subscription. The same number, the same app, just coverage, everywhere. That is a fundamentally different business, and once you see it clearly, the partnerships make sense, the financials make sense, and the risk profile snaps into focus in a way it simply doesn't when you're using the wrong map. So let's use the right one. The core technology is a phased array satellite, unusually large by LEO standards, capable of connecting directly to unmodified smartphones through standard cellular frequencies. No special chip, no firmware update. The phone doesn't know it's talking to a satellite. The business sits one layer above that. ASTS doesn't sell to you, it sells to your carrier. Over 50 mobile network operators have signed on as partners. The binding commercial agreements, the ones with real financial commitments, include AT&T, Verizon, Vodafone, and STC. The carriers handle the customer relationship, the billing, the regulatory interface in their home markets. ASTS provides the orbital infrastructure and collects a wholesale fee. That structure matters more than most people realize. It means ASTS doesn't need to acquire a single retail customer. It doesn't need a brand. It doesn't need a sales force. It needs satellites in orbit and a working signal. And the carriers do the rest. The addressable market isn't people who lack internet access. It's the billions of existing mobile subscribers who occasionally, or frequently, fall outside coverage. Rural areas, dead zones, oceans, mountains. Every one of those moments is a potential revenue event. The competitive moat, if it holds, is spectrum rights and orbital position. ASTS has secured spectrum licenses that took years and weren't cheap. The first company to hold spectrum and demonstrate technical viability has a structural advantage over anyone trying to follow. That's the first mover argument, and it's a real one. Here's the honest question, though. When you first imagined satellite broadband, did you assume you'd need new hardware? Most people do. That assumption is exactly what ASTS is betting against. The idea that the phone you already own is enough. Sit with that for a moment, because it's the heart of why this either works spectacularly or fails quietly. The caveat belongs here, not buried later. This model has never existed at commercial scale. The technology has been demonstrated. The partnerships are signed. But a signed agreement and an active commercial service are not the same thing. The gap between them is where most of the risk lives. For 2025 revenue, $70.9 million, year-over-year growth of 1,606%. That sounds extraordinary until you note that 2024 revenue was $4.4 million and 2023 was zero. The percentage is real. The base is almost nothing. More importantly, none of that revenue is commercial D2D service. It's gateway fees and government contracts. The actual product, your phone connecting to space, has not generated $1 of commercial revenue yet. That's not a criticism. It's a fact that determines how you should read every other number. Gross margin of 50.3% is structurally healthy. Operating loss was minus $287 million. Net loss, minus $341.9 million. Diluted EPS, minus 1.34. EBITDA, minus $370 million. These are large, negative numbers, and they should be. You don't build a satellite constellation at cost efficiency. The question is not whether the losses are big, they are. It's whether the company has enough runway to reach the other side. The balance sheet is where the real story is. Total assets hit $5 billion at year-end 2025, up from under $1 billion the prior year. Cash and liquidity sit near $2.78 billion. Current ratio of 16.35, essentially no near-term solvency risk. They raised $2.3 billion in equity in a single year. CapEx ran $1.1 billion, almost entirely satellite manufacturing and launches. Free cash flow was minus $1.2 billion. The company is not bleeding, it is spending. That distinction matters a great deal. Bleeding means the model is broken. Spending means the model hasn't started yet. 2026 guidance is $150 to $200 million as Block 2 satellites enable the first commercial ramp. The price-to-sales ratio right now is 311 times. That number is not a mistake. It reflects the fact that the market is pricing in a future revenue base that doesn't exist yet, and paying a significant premium for the optionality that it arrives. If revenue inflects the way the bull case requires, that multiple compresses rapidly. If it doesn't, the multiple becomes the story. If you are buying ASTS at current prices, you are not buying a business. You are buying a bet on a deployment timeline. Be honest about that with yourself. Institutional ownership sits at 41.75% of shares outstanding, which is meaningful for a company this early in its commercial life. The composition matters more than the headline number. The largest holder is Rakuten at 10.6%, and Rakuten is not a passive fund. They are a strategic partner with a direct commercial interest in the success of the D2D model. Vanguard holds 7.34%, BlackRock 4.08%, Alphabet is in at 3.06%, Vodafone Ventures at 1.87%. When the company's largest shareholders include carriers and a global technology platform, you're looking at alignment of interest, not just capital allocation. These holders have reasons beyond share price appreciation to want this to work. Now the tension. The analyst consensus rating is reduce. The average price target across 11 analysts is $63.77. The stock is near $86. That implies roughly 26% downside from here, using the street's own math. Only Deutsche Bank carries a buy, with a target around $139. Bank of America sits at neutral, $100. The easy response is to dismiss the analysts. The smarter response is to understand what they're actually pricing. Analyst consensus on a pre-revenue infrastructure company is a model of assumptions. Nobody knows what ASTS's revenue will be in 2028. They're building DCFs on projections of projections. The bears are weighting execution risk heavily, and they're not wrong to. Launch delays are real risks. Spectrum disputes are real risks. The spread from $42 to $139 across the analyst community is not disagreement about valuation methodology. It's disagreement about whether the milestones get hit. The consensus says reduce. Does that make you more cautious, or does it make you think about what consensus has historically said about companies like this at this stage? Neither reaction is automatically correct, but one question is more useful than the other. 3 futures, each one conditional on specific things being true. The base case, roughly 60% probability, assumes the Block 2 launches proceed close to schedule and the constellation reaches sufficient density to enable commercial service by 2027. The MNO partners begin converting their contractual commitments into active revenue. Backlog exceeds $1.2 billion in commitments. Even partial conversion changes the financial picture materially. Revenue reaches $1 to $2 billion by 2028 to 2029. Losses narrow. break-even becomes visible. Share price in this scenario? $120 to $180. This doesn't require anything exceptional. It requires the plan to more or less work on the timeline they've described. The bull case, 25%, requires full global coverage, rapid and broad MNO uptake, and ARPU realization across the subscriber base at scale. Revenue approaches $5 billion or beyond. EBITDA margins move toward 70%, which is achievable in a capital-light operating model once the constellation is built, because the incremental cost of adding a connection is low. In this scenario, ASTS becomes the invisible infrastructure layer beneath global mobile coverage. Share price, $300 to $500, potentially more. Guru Focus intrinsic value estimates reference roughly $300. This is not a fantasy, but it requires things to go right in sequence, at speed, across multiple geographies simultaneously. The bear case, 15%, is worth taking seriously, not dismissing. Launch delays push commercial service past the window where capital markets remain patient. Spectrum disputes in key markets stall international rollout. Starlink accelerates its own D2D capability faster than expected, narrowing the first-mover window. The company returns to capital markets under stress, diluting existing holders meaningfully. The cash position buys time, but not infinite time. Share price in this scenario, $10 to $30. The cash on the balance sheet is real protection against an abrupt failure, but it doesn't guarantee the thesis survives. What determines which scenario materializes? Three things, and they're all observable. Satellite deployment pace. Are the Block 2 units launching and achieving orbit on schedule? Regulatory clearance. Are the international approvals moving through MNO partner channels in key markets? And commercial service activation. Do the carrier agreements translate to live service for end users in 2026 or 2027? Watch those, not the stock price, not the analyst upgrades, the milestones. Which scenario do you think is most likely right now? And more importantly, what would have to be true to change your mind? That second question is the more honest one. Most investors know their thesis. Fewer know what would break it. Here's the only thing you need to carry out of this video. ASTS is not a company you evaluate by its current financials. It is a company you evaluate by whether its milestones are moving in the right direction. The financials will look terrible until they don't. The analyst consensus will be cautious until it isn't. The valuation will look stretched until the revenue arrives, and suddenly it doesn't. The question was never whether the stock is expensive today. The question is whether the infrastructure gets built on time. Watch the satellites. Watch the launches. Watch whether AT&T and Verizon activate commercial service. Everything else is noise. This video is for educational purposes only and does not constitute financial advice. The analysis here reflects publicly available information and one interpretation of it, not a recommendation to buy, sell, or hold any security. Do your own research. Your decisions are your own.